Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are running through one of our key fundamentals when buying a property, buying an investment property that is getting the timing right based on the 18-year land cycle. So the 18-year land cycle consists of 14 years of expansion, 4 years of downturn, and during the 14 years of expansion, it's interrupted with a mid-cycle slowdown, which we last experienced that during COVID. And we are now on the blue marker. We've recovered out of COVID and we are away at the races in the midst of the land boom. Similar period of time, 2005 now, based off the last cycle, in the lead up to the 2007 peak before the market went through the GFC or um, the land-driven downturn. So the last prior land-driven downturns, as you may recall, 2008-9 GFC, the 91 recession we had to have, 1972 recession, and then going back in history, 1955 and 1932. So these large land-driven downturns come around every 18 or so years, and they are brought on after a period of boom, speculation, a lot of credit creation, higher inflation, higher interest rates. So they set patterns throughout each separate market. So typically Sydney and Melbourne lead the first half of the cycle. We then get to a point where Sydney and Melbourne then become too expensive. People then decentralize and look at more affordable markets such as Brisbane, Perth, Adelaide, and the regions. So it's not a coincidence that Brisbane, Perth, Adelaide, and regional New South Wales, regional Queensland, WA, South Australia, and Victoria had boomed due to COVID. It's part of the decentralization from the more expensive metro markets such as Sydney and Melbourne. So I use this as a framework to understand where we sit in terms of each market cycle, because it's not one cycle when you're talking property. Every metro market, every state, every region run their own race at different times of their own cycle. And also you can dig into more granular level of even types of property. So units versus villas versus townhouse, houses, blocks of units, new and off the plan type of stuff. So I don't get into new and off the plan, or buy new and off the plan, but a lot of developers will start building new stock and releasing it to the market. So now even as a speculative asset, new and off the plan potentially could go well over the next couple of years, but once the market turns, it'll then go horribly wrong. So there comes a time for each type of asset, and over the long term, we stick to established properties because they have gone through the test of time. They've been built 20, 30, 40 years ago. You can then buy them for less than the intrinsic value, which is less than replacing the same asset. So we stick to the established properties, but we use this 18-year land cycle as a key framework to work out which market to buy in, as we can study history, the sales data history, and overlay it on this framework and see how the markets perform historically, which will then allow us to paint a picture of where they're potentially heading moving forward. So I believe this is probably one of the most key pieces of information and data to use, which I don't see anyone in the industry in terms of from a buyer's agent perspective using this data. They use different metrics of what markets are actually booming to get into and to buy in, but it's not necessarily the booming markets you want to get into, as I'll show you in the future slides, because when the market turns, they will then no longer be the performing markets, and other markets will be, such as Sydney and Melbourne in the future years to come. So to show you a bit of a dig dive underneath the hood of how each metro market is currently performing. I run these reports every day of the week when looking at property. They are one of our key fundamentals when buying an asset, when we buying a property, even going to the different types or even down to the different suburbs. We run these reports and we look back at history to see, okay, how has it performed? How is it performing now? And where is it potentially heading moving forward? So to kick it off, let's start with Perth. As you can see, we are now, this is units. So I've for apples comparison across all the metro markets, I've selected units as we like to buy units in the metros. Um, Units in in Perth, this specific suburb in Perth is median price is 500,000 here, based off November 2024. And if we go back in time, based off the 18-year land cycle, we're in a similar period of 2005. So as you can see, between 2004 to 2006, Perth in this suburb had a significant bull run. So we're in the midst of this same bull run based off history. So it's only going to be a matter of time where the market will top out in Perth and then go through this protracted period of flat to stagnant growth where, yes, you have a year of up, then you might have a year or two down and a year or two up, but up and down within that, based off history, between 300 to 350 grand, not until 2022 where it broke through that 350 band and consistently stayed above it and then went to the whole next level. So now we see that Perth is now becoming more risk to the downside based off history. It's had its big run the last few years since the commencement of the upturn in 2020. So for the last 3 to 4 years, it's had a strong run. And typically markets go through a period of anywhere between 10 to even up to, I guess in Perth's situation, like 12, 13 years. So from 2006 to 2020, so that's 14 years of stagnant to flat growth before it then goes through a period of 4 to 5 years of 100 to 150% growth, which you'll then top out, come back 10 to 15%, and then go through another protracted period of flat growth again. So this is why we use this data to overlay on the 18-year land cycle to understand where the market currently sits and where it's potentially heading moving forward, as we like to get into the markets before it goes through its significant bull run. So we like to start buying in markets when we see them being flat for anywhere between 8, 9, 10 years, because it's only a matter of time where it'll then hook into its next growth cycle. So with that, let's keep moving forward to Brisbane. Similar story. Brisbane is away at the races, just like Perth is. Similar story happened between 2004, lead up to the peak in, say, around 2007. Then from 2007, really only until 2021 is when it hooked through its next growth cycle. So that protracted period of flat growth around that 200,000 mark for 2007 to 2021, let's call it another, good 12 or 13 years. So this is why we started buying up in Brisbane around 2018 and continued to buy in Brisbane until around 2022, 2023. But as of this year, we've been advising clients that we are no longer buying in Brisbane because it's becoming too hot, too competitive. You pretty much have to overpay. I mean, there's some scenarios where you have to pretty much buy within a day or two without even seeing it. Otherwise, it just sells. It's just absolutely going crazy. So we don't like to keep buying in markets when they get that hot. Yes, they are in a growth cycle, but the best time to buy is between 8 to 10 years, that last couple of years where it's been protracted period of flat growth, because most people look in the rearview mirror and say, well, it's been flat for so many years. Why buy there? Well, the answer to that is the risk to the downside is pretty much minimal once it's been flat for a good long period of time, and it's only a matter of when it's going to hook into its next growth cycle. So um, that's why we started buying here, but no longer buying anymore, as we'll probably see another probably 30-40% growth in Brisbane. But once the market tops out in the next year or two, it's then going to commence another 10 plus years of flat growth. So this is another reason why I'm looking to sell out of Queensland and Brisbane. Not all the assets, but consolidate a bit and sell down some assets, because I would rather sell out at the peak of the market in, say, 2027, 2028, pay down debt, raise cash to then reinvest into other suppressed markets in larger assets to then capitalize on their next growth cycle. Rather than holding an asset for 10 plus years at the same price point, you can reinvest the gains. Yes, you'll pay capital gains tax, and yes, you will need to talk to your accountant around what that looks like for your personal situation. But when you run the numbers, and if you can put that money into a bigger asset that's going to cash flow better, so for example, selling a unit or a house, paying down a few $100,000 in debt, paying a few thousand, or yeah, 50, 60, 100,000, depending on the capital gain and your personal income, the tax, and then if you can raise a couple of 100,000 in cash, you can then use it as a deposit for a larger asset, such as a block of units that will cash flow better. That's in a market that's primed for its next growth cycle. So, and that's a good way to scale up. So I like to move and shake a bit rather than holding. Yes, you got to be in the game for, well, for me, forever, but I like to trade markets once they've had their good growth run to then reinvest into other markets that are yet to go through their next growth run. So capitalizing on this data is the most powerful way to build a portfolio and scale ahead of any type of renovation, cosmetic renovations that you may want to do. Yes, they'll obviously add value to your assets, but nothing is more powerful than understanding and studying this land cycle and using sales data, historical sales data, to paint a picture and understand where a market sits and where it's heading moving forward. So that's Brisbane. Adelaide, again, has had a significant growth cycle, as we're in the second half of the cycle, where Brisbane, Perth, Adelaide are hooking and going gangbusters. But as you can see, there's probably another couple of 2 or 3 years before it will then more or less flatten out for a good protracted period. So between say 2010 to 2020, so there's your 10 years of flat to subdued growth prior to it then hooking through its next growth cycle. So we see Adelaide has a little bit more growth, but more or less has reached its limits, and probably only another, say, 20 to 30% potential gains in the near term before it will then top out and then go through another protracted stagnant period of flat growth. So that's another market we're no longer looking at or advising. Yes, I continue to keep tabs on all these markets and working out where's the best market to put my money and clients' investments as well. But Adelaide's ship has well and truly sailed for probably another 5 to 10 years. Sydney, we are getting super excited in Sydney. We've been buying in Sydney for probably the last 2 years now. As you can see, it had its significant bull run in the first half of the current cycle. So from 2007 to lead up to 2014, even further to 2016, 2017 peak. We then topped out in this specific suburb in Sydney, and then we've been up and down, stagnant, flat for pretty much since 2017. So we're picking up deals now for cheaper than what people paid in 2015, 2016. So that's a good indicator that we're getting deals now that have been flat for a number of years, as it will only be probably another 2 years away before it will then commence its next growth cycle. So we're in 2000 equivalent 2005. I see next year softening. So we've had a pretty strong run this year, or probably like the last 2 years. But this upturn here, I believe, based off history, is going to soften as we commence the next land-driven downturn post 2026. And then come 2027, that's when it's going to hook into its next growth cycle. So that's why we are now sowing our seeds in Sydney in preparation for this next growth cycle, which I believe will commence around 2026, late 26, early 27 and onwards. So now is the time to be ploughing in. So some people say, well, are we too early for Sydney? I don't believe so, because the deals we pick up, it's all in the price you pay. So yes, this is the average. I mean, this is for units in Sydney. What are we near? Close to just under 500,000, so 480,000. This is the medium. We're picking up units in Sydney for sub 350. So when you get a good deal, it doesn't matter if the medium's going to soften in the next year or two, because we're already making 100 grand under the median price on the way in. So you'll be able to refinance the loan, borrow your equity out, borrow your deposit money plus closing to reinvest and keep going. I like to buy now in Sydney because as it is suppressed and it's even getting more softer, that's where the opportunity lies. And that's where you can get great deals. You don't have heaps of competition from other buyers, because they're all plowing into Brisbane, Perth, Adelaide, but they'll end up paying overs and then holding an asset for 10 plus years with next to no growth. So that's why we're focusing on Sydney. Typical classic saying, Warren Buffett, you want to be greedy when others are fearful, and fearful when others are greedy. Right now, pockets in Sydney, people are fearful, cautious. They are holding back as stock levels are rising. It's softer market. This is the best time to buy. We are super greedy versus Brisbane, Perth, Adelaide that are absolutely going gangbusters, and you have to buy an asset within a day or two, otherwise you miss out. We're buying assets that sit on the market for a couple of months. So it's good to be able to get into the markets when they're soft in preparation for their next growth cycle. So that's Sydney. Melbourne again. Melbourne is, I believe, is starting to commence its next growth cycle. I'd say it's pretty much bottomed out. It's had a bit of a tough time through COVID the last few years with the lockdowns, but also the tougher laws for landlords. It's the land tax threshold down there is 50,000, so that's suppressing the market. But all these are starting to come off. Even recently, we see that there's no stamp duty on some new and off the plan apartments and townhouses down there. So that's only the start. There will be the riggers and removed in the years to come. And then I believe confidence is starting to already creep back. It's becoming, I wouldn't say mainstream, but I guess people in the industry and investors in the industry, people who understand the markets, can see value now. And we're finding great deals. I mean, we're buying anything sub 300 grand in Melbourne, so between that 280 to 300 grand. So medium price around that four to 450 mark. So we're getting well under the median, well under the intrinsic value, well under the replacement value. So we are super excited on Melbourne, getting yields of 7% rental yields in the metro market. So great time to be buying in Melbourne. So probably just a little bit more context. This is how I see the market. So this is how I gauge based off the 18-year land cycle, plus looking at sales data every day of the week. I see Melbourne pretty much reached its bottom. It's bottomed out. Rents are starting to rise. I mean, I've got a block of units down in Victoria, and I'm already pushing the rents without even really doing any significant renovations or anything, just because the market's starting to move. Rents are starting to be easily pushed up. So that's pushing yields. So it's getting the 7, 8, 9% rental yields now. So those higher rents get capitalized into higher prices. Prices then start to rise, and then FOMO. Sydney is still soft, low competition, and is softening probably the next year to year and a half, but is cracking time to buy. So we like to buy between negative media and rising rents is the ultimate period between where we like to buy. So right now, the commentary we're hearing in Melbourne and in Sydney was the same commentary we're hearing in Brisbane back in 2018. So when I was buying in Brisbane in 2018, 2019, people thought I was crazy. Why are you buying in that market? It's never going to grow. It hasn't gone up anywhere in 10 years. But we were buying units for less than 160 grand within half an hour to the CBD of Brisbane. So, and these days I could flog them for 400 bucks, 400,000 each. So units do grow in value. They, if you time them right, they outperform houses. There's a reason why the biggest investor in Australia, Harry Triguboff, only invests in building high-rise apartments. So anyone that says steer away from apartments doesn't know what they're talking about. Obviously, yes, you have to be cautious to get into the right market at the right time, using the 18-year land cycle, but then also getting a great price and buying established apartments that are purchased significantly under the median price, under the bank valuation, under the intrinsic value. So the intrinsic value is what it costs to replace the same asset. So in the current market now, it costs anywhere between 600 or 550 to 700,000, depending on which market, to build a unit. So if you're building a block of 10 apartments, it'll cost anywhere between 5.5 million to 7 million bucks. So if you're buying an established apartment for half of that, it can only go one way. It can only go up. So if you're buying it for well under the intrinsic value with a strong yield, the yield will get capitalized into a higher price, and then the market just continues to move on. So Sydney, Melbourne is where we're focusing on. We're no longer focusing on in the next probably 5 to 6 years for Brisbane, Perth, Adelaide, as they're going through their FOMO, and then they'll top out. And then the regions are a little bit more tricky. They run slightly different to New South Wales and Victoria region. That is to Sydney and Melbourne. Sydney and Melbourne lead the cycle. They lead the recovery. They then top out, and then people then decentralize into the regions and the more affordable markets. So that's why New South Wales and Victoria have also had their big bull run with the smaller metros, and they have more or less topped out now, I believe, based off using the sales data, and they're now starting to soften. So there's time on those markets. I'm starting to offload some New South Wales property. Probably could have done it a bit earlier, but looking to sell early next year to then realize those gains, pay the capital gains tax, reinvest the capital gain into Sydney and Melbourne to then capitalize on the next growth cycle. So this is how I see the market moving forward. If this information resonates with you, shoot me an email, send me some feedback, let me know what your thoughts are, your plans are. If you've got any existing property, happy to run some property reports, show you the sales data of your existing property, get you on a call to discuss your next move and how I can help from a buyer's agent perspective to help you source your next investment grade property. As always, this is by no means financial advice. This is just general information in nature. This is my thoughts, what I'm doing, what I'm helping clients with, understanding the 18-year land cycle, the power of the 18-year land cycle, and how you can capitalize on historical sales data to get ahead of the mainstream and become part of the 1% of Australians who own 6+ investment properties and achieve financial freedom. So if you are keen to join the community, build a portfolio, get in touch today. I'll put my details in the comments below. Until next time, thanks for watching.